So welcome to our Create Great Credit class. My name is JC Finley, your presenter. I work on our outreach team at Denver Community, which includes our financial education, how staff become financial coaches, volunteering, projects, and I've been a financial counselor for about 2 years now, and I've really enjoyed it. So I hope you can find something helpful in this Create Great Credit class we have today. So what is a credit union? If you're not already familiar with what a credit union is, we provide not-for-profit banking products, loans, and other services. Credit unions are owned by our members, so they have a say in how the credit union is led and operated. Every member is an owner, so it's a democratic financial institution where members, where members can vote for the board of directors to have a say in how the credit union is ran. So a little bit about how credit unions work. So first, you deposit your money with us. That we use that money to make low interest loans to fellow members. And then the profit from those loans is put back into the credit union and returned to you as better rates and fewer fees. So our mission is to educate, deliver, and achieve. We are a not-for-profit financial institution that's been in the community since 1934. This class is a part of our Clear Money financial education program, so that includes our financial coaching, our in-person, which are now virtual financial education classes, and our e-learning classes that are available 24/7 on our website for free. So who is Denver Community Credit Union? What makes us different than any other credit union out there? So first, we are difference makers. More than 1,264 people have attended online and in-person classes in 2019. We are financial mentors. So we have provided over 286 financial coaching sessions in branches in 2019. And I can tell you that number is even higher this year in 2020. We are local, so we have 89 employees, and they volunteered 1,281 hours in 2019. And lastly, we care about our lasting impact. So over 35% of our households have been members for over a decade. We want to take care of our members and improve their financial health. So to familiarize you with some credit and terminology vocabulary, we'll talk about 4 different people's credit situations here. So first, we're going to talk about Brad. He has 0 trade lines or lines of trade. Those words can be interchangeable. He has, so lines of trade or trade lines are open and active loans, credit accounts, or lines of credits. And these are being reported to the credit bureaus. And there's a total of 3 credit bureaus: Experian, TransUnion, and Equifax. And we'll go into those a little bit more later. We have different loan types. So there are revolving loans. These are like credit cards and other lines of credit where you can use up to a certain amount and continue to pay it off. Where installment loans are set up slightly differently, and this is any loan paid in installments over a specified term. So this can be like an auto loan, a mortgage, a personal loan, where you're just paying that same amount every single month until the loan is paid off. And Brad has had 2 inquiries in the last 6 months. What an inquiry is this happens when a financial institution or company checks your credit. If you've applied for a loan, which is a hard inquiry, and we'll talk about that in a second, it'll take about 3 to 5 points off your score about a month later, even if you don't open the loan. So for the start, we have soft inquiries, and these do not impact your credit score. So you're never penalized by pulling your own credit information, and you can opt out of those pre-screened offers. And what I mean when I say pre-screened offers are those offers you get in the mail that have said, you've been pre-approved for this credit card. So you are able to opt out of those and not have to get those in the mail anymore. So a soft inquiry could be used for like a background check or for housing purposes. And the way to opt out of those pre-screened offers is optoutprescreen.com, and I can share that later as well. Utility companies may use a soft inquiry, but always make sure to ask if this will be a soft or a hard inquiry, because if a company does do a soft inquiry, but it does impact your credit, they do have to remove that. And the hard inquiry, it does impact your credit score. As I mentioned earlier, it'll take about 3 to 5 points off of your score about a month after you apply, regardless if you open the loan or not. There are special exceptions for auto loans and mortgages. And what this means is you can shop around at multiple lenders or multiple mortgage companies, you name it, over a 14-day window, and it'll only impact your score one time. So if you wanted to go to 5 different credit unions over that 14-day window, that's totally fine. It'll just be one inquiry on your credit score. But if you were to go to 5 credit unions during that 14-day window and then go to a 6th credit union on the 15th day, that would be a new inquiry on your score because it was outside of that 14-day window. Next, we have Greg. So he has unpaid collection accounts. So what this is debts owed to lenders or companies that are typically sold to a collection agency after 180 days of no payments being made. When it does get sent to a collection account, it displays as a new additional negative account on your credit report. So it was originally with your lender, and then they added a new account on your credit report for that collection. Any collection account can be damaging regardless of the balance owed. It could be a $25 parking ticket or it could be a $2,500 medical bill. They will both be very, very damaging to the credit score. Paying off a collection account significantly improves your score. So when I work with members and we're working on building credit, what I always say is pay off those collections. That's going to help your score grow tremendously. The length of Greg's credit history is 72 months. So he's been using credit for, a few years now, but the longer you have a positive credit history, like on-time payments, the better your credit score will be. So you want to try and keep your credit history as long as possible. So if you open a credit card when you turn 18 or 20 years old, you want to keep that credit card open for a long period of time to extend your credit history. Next, we have Helen. So she has 39 trade lines and 24 paid accounts. That means she has 39 lines of trade, loans, credit cards, things like that. I would assume Helen is like a business owner. Her paid accounts, so that means they are paid and they are on time. Current on accounts, including mortgage. That also just means that she's current, she's paid on time. She has about $10,500 in credit card balances, but has a total available revolving credit card of almost $70,000. So Helen's credit utilization is at about 15%, which is a pretty good ratio. We'll talk a little bit more about credit utilization and what we like to use as our credit utilization ratios in a little bit. She has no delinquent accounts. That means that everything is paid on time. She doesn't have any late payments. And talking about late payments, if a late payment is reported to the credit bureaus, it can stay on your credit report for up to 7 years. I tell people that, but I don't want that to scare you. Just because it's on your credit report for 7 years does not mean it's impacting your score for 7 years. So typically you'll see a hit after that late payment, but as long as you continue to work on your credit and make other on-time payments and nothing gets out of schedule, that should stay. Your score should go back up eventually. And typically late payments are reported after being 30 or more days late, but not always. So typically if it's going to be reported as a late payment, it has to be not paid for 30 days, but that's not always the case. Some institutions or some lenders will count it as a late payment if it's after 2 days late, but typically it's about 30 days late to report a late payment. Next we have Sarah. So Sarah filed for a bankruptcy in 2015, and talking about bankruptcy, most bankruptcy filers repay debt after filing Chapter 13, which stays on your credit report for 7 years. Chapter 7 bankruptcy is less common, and that does stay on their credit report for 10 years. Sarah has had 9 inquiries in the last 6 months. So that means over the last 6 months, she's tried to get some sort of credit 9 times. And Sarah is maxed out on all of her credit cards. So that refers to your credit utilization, the percentage of the limit used on a revolving loan. So in this case, Sarah would be at 100% because she's using all the available credit to her. And what maxed out means is just at or above the limit on a credit card or a line of credit. So if I had a credit card for $1,000, if I had $1,000 or more on that credit card, that would be a maxed out credit card. Keep these 4 people in mind as we go through the rest of this class. We'll discuss who would have the best credit score at the very end. But Sarah has not missed one payment since bankruptcy. So you can see she's been making on-time payments, which is really, really good for the credit score. So a little quiz question for us. What is the best definition of credit? Either A, credit is a number that lenders use to determine whether to give you a loan or not, or B, credit is confidence in a borrower's ability and intention to repay. And the answer here is going to be B. So the overall idea of credit is just seeing if someone's going to be able to pay back this loan or not. The letter A definition is actually the definition of a credit score. So it's that number tied to the credit report, which we're going to talk about in a second. So credit reports. What's in a credit report? It's going to include your personal information like your name, social security number, birth date, at previous addresses, phone number. It does not include any of your income. So your bank account information will not be included on your credit report. And businesses, including lenders, do not have to report to the credit bureaus. So before getting a loan or a credit card, it's important to ask if this lender or agency will be reporting your credit history and your credit information to the credit bureaus. And you can ask which credit bureaus they report to, because not every organization reports to all 3. There's 3 separate credit bureaus, and they are for-profit companies: Experian, TransUnion, and Equifax. Some more information that's going to be included on those credit reports is going to be your loan account information. So any loans that you've opened over the last 7 to 10 years, if they've been opened, closed, payment history, your credit utilization, balances on those loans, and loan payment status. So if you've had any late payments. Public records, so things like bankruptcies, foreclosures, tax liens, and civil judgments, those will also be on your credit report. We just talked about inquiries, and you also see an area on your credit report where you've had where any inquiries have happened. So this is also called a hit on a credit report. So anytime a credit report is pulled, and we will discuss that a little bit more soon. As I mentioned, what's not included: income, race, employment status. Some of these things are included, but not a part of the score, like your age and your address. And your credit scores are only based on information in your credit reports. So if your credit report is missing key information or missing one of your loans, that's important to get that added on there, because if your loan is not on your credit report, then it's not helping to build your credit. And so this is just an example here. We have our 5 information zones. So as I was mentioning, first we have your personal identifying information: name, address, social security, date of birth. All your personal information is going to be in that first section. 2 is going to be public records. So that's where I said foreclosures, bankruptcies, tax liens, anything like that will be in that category. So as here, there is just no public records. Section 3 will be any collection items. So as we can see here, there is one collection item from 2018. It's a $500 collection. So it is important to look at that area. That's a key area to look for anything that could be wrong or any red flags. 4 would be a trade line. So all of your lines of trade are going to be here, whether it's your auto loan, credit card, any loans you currently have in your name should be in this area. And lastly, we have inquiries. So that's when anytime someone's pulled or checked your credit report, and they can be hard inquiries and soft inquiries in this area. So for example, I use Credit Karma very frequently, and I'll see the Credit Karma inquiries in this section, even though I know it's not impacting my credit score because Credit Karma is free. So mistakes are common on credit reports. Sometimes it can be fraud or identity theft. Sometimes it can be someone with the same name as you or the same birth date. And these mistakes can be costly down the line. So it is important to pull your reports frequently through the federal website regularly with no sales. That's at annualcreditreport.com, and that's free reports every 12 months. And due to the pandemic right now, reports are available every week through April of 2021. So if you haven't pulled your credit reports this year, I highly recommend it. And you can pull them every week through April of 2021. Afterwards, you'll be able to pull these once every 12 months again. You can dispute errors and inaccurate info and have it removed for free. So there is a dispute option on annualcreditreport.com, and this is awesome. So you can just do everything directly on there. So what's the difference between credit, a credit report, and a credit score? So as we mentioned earlier, credit is just the overall idea, is someone going to be able to pay me back on a loan or not? A credit report is just a written history of how you've used credit. So we've talked about all your lines of trade will be on there, your personal information. It's just a written history of how you've used credit. And lastly, a credit score is just a number tied to your credit report. So the way you've used credit, they'll calculate a score and it's tied to that report. So any information that's not in that report will not be included on the credit score. And why is credit important? It impacts a lot of aspects of our lives in addition to borrowing, which we'll get into shortly, such as utilities, affordable loans, equipment, and access to education and business loans. So when is a credit score important? So first we're going to look at checking account. In this case, both credit can be important, it cannot be important. So some institutions will check your credit score before you are able to open an account. At Denver Community, we do not check a credit score. We check something called check systems, and that's just to see if you have an outstanding balance at another financial institution. But sometimes you will have to have a certain credit score to get a checking account. So it is important to ask that before joining a financial institution. Getting employment. So sometimes your credit score will be checked before getting a job. For example, my credit was checked before getting a job at the credit union, but it was not checked when I was just being a waitress in college. So it probably depends on the area of work you'll be getting into, but sometimes your credit score is important for getting employment. Payday loan. So a credit score is not important for payday loans. I highly recommend staying away from payday loans if you can. They oftentimes have very predatory rates. It's very, very hard to get out of them. A lot of people end up getting a payday loan to cover a payday loan, and it's just a vicious cycle. So credit is not important for payday loans, but they charge a very, very high interest rate, so I do not recommend these. Renting a place. So your credit is important for getting rent or renting at an apartment complex. So for example, I had my credit checked before moving into this apartment. It was able to save me a lot of money because by having a good credit score, I was able to pay less in my security deposit. So instead of having to put down a full month's rent, I only had to put down $500. So your credit is important for getting new rent or finding a place to live. An auto loan. Credit is very, very important for auto loans, and we'll go through an example here really soon on this. How this works is based on your credit score, that'll put you in a certain tier for your interest rate. So it is important to have a high credit score to help save money on paying interest on an auto loan. Pawn shop. So a credit score is not important for a pawn shop. There is no credit really involved in a pawn shop. And as long as they have your item for collateral, they won't really care about your credit. A rent-to-own store. This one can go both ways. I used to think that credit was not important for a rent-to-own store, but lately more and more members have been telling me that when they've gone there, they have checked their credit. So a rent-to-own store can go either way on this one. Mortgage. So if you're going to be getting a mortgage, this is probably when credit is going to be most important for you. Mortgage is for most of us some of the biggest purchases we make in our lives. So you want to make sure your score is as high as possible before getting a mortgage or a home loan. Auto insurance. So actually having a higher credit score can lower your auto insurance premiums. This was not something that I was aware of. You obviously want to have a good driving history as well, but having a good credit score can lower your auto insurance premiums. So now we're going to talk a little bit more about the FICO credit score. And the FICO is used by 90% of lenders, and the higher the score, the better. These range from 300 to 850. 300 is the low and 850 is the high. And this is based only on information in your credit report. So I've said this a few times now, but if that information is not being written and applied to your credit report, it will not be included in your credit score. The average FICO in Colorado is about 718 in 2019 and ranked 13th in the nation, up from 688 in 2017. The number one state is Minnesota. 733 is their average score, followed by a tie between the Dakotas, which is 727 is their average. The Boulder Metro actually has the highest average FICO score of 743. You will have a total of 3 FICO credit scores, one from each credit bureau. So they will vary slightly, so you may not have the same exact score from each credit bureau, but that's okay. It's calculated based on 5 categories, and we'll go over those in the next slide. The importance of the categories varies by the person depending on their credit profile and how long they've been using credit. You can get a free monthly FICO score on the Experian app. So I highly recommend downloading that app if you don't have it already. So you are able to get a free FICO score every month. There are other companies like Credit Karma and CreditWise that offer free credit scores, but they're typically not a FICO credit score. They're lower cost scores that are not used in typical lending decisions. The lower cost scores are not used in lending decisions, but typically used for those pre-approval things. So like you get in the mail, like you've been pre-approved for this Discover card, which is a soft inquiry. I personally still love to use Credit Karma and CreditWise, even though it's not a FICO score, but it helps me track trends in my score. So if I see that my Credit Karma score is going up, I can assume and know that my FICO score is probably going up as well. Factors that determine a FICO credit score. So first, we have payment history, which is 35%. I know I've mentioned probably on-time payments a few times throughout this presentation, and it's so important that we have on-time payments because this is the largest chunk of your FICO credit score. So payment history factors can include how recent was the most recent delinquency, collection, or public record item, and how severe was that delinquency? Was it 30 days, 90 days? Did it go into a collection? How many credit obligations have been delinquent? Have you made multiple late payments, just one? So things like that will be taken into consideration with your payment history. And on-time payments to installment loans helps more than on-time payments to revolving loans. Building credit takes longer if you only have one open credit account. I don't recommend getting into costly debt to build credit. There are always affordable ways, which we'll cover here in a few minutes. Next, credit utilization. So this is what I talked about earlier, that percentage that you're using on those revolving lines like credit cards. And that's 30%. So that's the second highest amount for that FICO credit score. And sometimes this credit utilization is called outstanding debt. We like to recommend that the credit union, that you keep your credit utilization right around 10% to grow your score as much as possible. So for example, if you had a credit card that was $1,000, you'd only want to put about $100 on that card a month to grow your score as much as possible. You can use that utilization up to 30% if you'd like your score to remain more stagnant or just remain the same. So we recommend keeping your credit utilization between 10 and 30%, but keep it closer to that 10% number if you're looking to grow your score as much as possible. Length of credit history, 15%. So how long have these accounts been established? The average number of months these accounts have been open. So it'll take an average of how many accounts you have to see the average length of credit history you might have. So that's why it's important to spread out when you open new accounts. Because if I were to have 2 credit cards back when I was 20, and then I open 5 new accounts now, that's going to shorten my credit history significantly. Next, we have amount of new credit, and that's 10% of a FICO score. So this is looking at your inquiries. So the number of recent credit inquiries over the last 12 months is really important for this category. The new accounts, number of trade lines opened in the last year, and FICO scores only consider consumer-initiated inquiries for the credit posted in the last 12 months. So that means that you have to initiate the inquiry. FICO scores do not consider the following inquiries, such as promotional, account review, insurance, or employment inquiries. So those do not count against your score or anything like that. Those are all soft inquiries. And then types of credit in use, that's basically talking, are you using installment loans, revolving loans, a mix of both? I always recommend to have a mix of both, but the last 3 of these do matter, your length of credit history, amount of new credit, types of credit in use, but really focus on the first 2, especially with those on-time payments and credit utilization. So make sure you're paying your bills on time, and then credit utilization, just keep the amounts owed on your balances, like your credit cards or HELOCs, keep those amounts owed low, and that will help build your score. So if you do a little brainstorming and thinking over the few people we went over at the beginning, who would have the highest credit score? It would be Helen. Helen had everything paid on time, no delinquent accounts, all of that stuff. And a little brainstorming question, is having credit the most important financial skill? And credit is a very important tool in your money management toolbox, but it's not the only tool. Managing your money in a way that helps you reach your goals is one of the best ways to be financially successful. You just want to use your money in the way that helps you, it's tied to your values, and you don't want to go into unnecessary debt to build credit, and we'll go over a few credit building products to prevent that. So here's a dollar impact of the credit score. So this is the auto loan example I was talking about a little bit earlier. These are not Denver Community's current loan rates, but just an example. Our website has a bunch of great calculators you can use to compare loan offers and calculate how much money you can use to pay off your debt quickly. So for this example, you're going to see these tiered ranges here. So if you have a credit score of 740 or higher, you're going to get 4% APR. Or if you have a credit score in the 600 to 639, you're going to get a 17.25% interest rate. So the cost difference here, looking at someone who has a 4% rate, looks like in someone who has either no credit or someone in that 600 to 639 range, they're both getting the same loan, $10,000 for 5 years, so probably like a used auto loan. And the person that has a perfect credit score, they're getting around an $185 a month payment, while someone else is getting $250 a month. So it's about a $65 difference, which when I first looked at that, I didn't think that was too bad for such a difference in the credit scores. But when you look at the overall interest paid on this loan, it is $3,943 over the life of the loan, just in interest. And I'm sure we can all think of almost $4,000 worth of things we'd rather buy than just paying interest on an auto loan. So good credit is about keeping more of your money and not spending it on interest charges, fees, and additional security deposits because you're high risk. So as you can see here, having a good credit score can save you a lot of money in the long term. And another thing when it comes to paying off auto loans, this is something I personally do as well. Ideally, you want to pay more than the minimum monthly payment if you can. So in that way you can pay off this loan earlier and you're paying less in interest, but always make sure to ask about prepayment penalties. One time I was locked in a loan, and if I paid off my car early, I was actually going to get a huge fee. So it is important to ask about any prepayment penalties you may receive if you pay off a loan early. So is it possible to have a good credit score if you don't use credit? No. Someone who does not use doesn't use credit and doesn't have a credit card or any sort of credit in their name would have no credit score. So they wouldn't have a 300, they wouldn't have a 600, they would just have no score. And you need regularly reported on-time payments to help build your credit. Hopefully, it's 6 months to build a good credit score. So you want to use about 6 months to help build your score and then go from there. During that 6 months, they're kind of compiling information to get you a score, because you don't just start at the very bottom at 300. They'll kind of throw you somewhere in the middle depending on how you're using that credit in your name. You can be considered a riskier borrower if there's no history or data repayment behavior. So for example, if someone were to come in and get an auto loan at Denver Community and they had no credit score at all, we can't see that they've had a history of repaying lenders and repaying people. So it is important to help build up a credit score before trying to get loans. And you can seem like a riskier borrower if you don't have any payment history there. So this is a really good example here. I'm looking at a few different people and their situations. So here's how 5 different people with FICO scores would see their scores impacted by the range of credit events. So we have Rachel's a 43-year-old teacher who owns her own home. She has a credit utilization of about 22%, so it's in that 10 to 30% category. Her revolving balances are about $20,500. She has a credit history of 25 years, so a long credit history there, and no recent inquiries and no delinquencies. So that's good. She has a strong score of 736. Next, we have Sophia. Sophia is a 26-year-old nurse. She rents her home. She's had a 30-day late payment in the last year and has had a charge-off in the last 2 years. So her credit utilization is around 67%, so it's a little bit higher than what we'd recommend. Her revolving balances are $5,670, so they're lower than Rachel's. She does have a shorter credit history of 8 years, but that does make sense since she's a 26-year-old. She hasn't had any recent inquiries, so that's good for her score. And then she's had 2 delinquencies. So that's that 30-day late payment and then that charge off. Next, we have Mike. Mike is a 51-year-old lawyer with 18 credit accounts who owns his home. His credit utilization is about 51%, so still on the little high side. We like to keep it 30% or lower. Revolving balances of $14,000, so that means he has a balance of $14,000 that he's working on paying off. His credit history he's had for 30 years, so quite some time. He's had 2 recent inquiries, so that would drop his score a little bit. And then he's had no delinquencies. So I would guess the reason that Mike's score is a little bit lower is because of his high utilization and those high balances. Next, we have David. David's a 22-year-old, a sales associate with 2 credit accounts who lives with his parents. So his credit utilization is at 26%, so that's a good number. His revolving balances are rather low at only $250. He does have a short credit history of only 2 years, and he doesn't have any recent inquiries or delinquencies, and he has a score of 710. Next, we have Maria. Maria's a 40-year-old software engineer who owns her home and has never missed a payment. So her credit utilization is at 12%. I like her utilization the best because it's closest to 10, and that helps grow your score as much as possible. Next, her revolving balances are about $6,500, so not super high. Her credit history she's had for 19 years, so she has a longer history than some people in this example. She's had 2 recent inquiries and no delinquencies. So looking at this credit action here, so if Rachel were to miss a payment by 30 days, this is where she could maybe expect her score to drop. Same thing if she missed a payment by 90 days. If she were to reduce her revolving balances by 25%, she could see a score increase between 750 to 770. Taking on a new personal loan, so it's going to add to her accounts, her lines of trade that she has, and it's going to ding her score by having an inquiry. That may drop her to a 710 to a 730. Maxing out her credit cards would drop her to a 650 to a 670, and so on. So this example I really like here to kind of show what doing some things may do to impact your score. So missing a payment, reducing those balances. So if Mike were to reduce his balance, he would see a decent jump here back up into the 700s. But overall, you can see, missing a payment by 30 days will not impact you as much as missing a payment by 90 days. That will be a bigger drop. Reducing revolving balances, you can see that's going to increase everyone's score. Taking on a new personal loan will lower it slightly, just because it's adding to your lines of trade, and you're going to have an inquiry when you reach out for a new loan. And then maxing out your credit cards, you can see how that would drop everyone's score a little bit differently. So as you can see, Maria may take a larger drop than Rachel. So building or rebuilding credit affordably. So some strategies: for your highest score possible, keep revolving loan balances up to 10% of credit limit at all times. So that's 10%, or you can even use less than that. That's totally fine too. Set alerts to stay on track and pay down your balances multiple times a month if you need to. So set an alert on your calendar or on your phone when you're supposed to pay your credit card bill so you don't have any late payments. Pay any credit card balances in full every month to avoid paying interest or that finance charge. So if you only pay the minimum, there's going to be an interest charge that's added onto your card and can be really hard to pay off. So if you can, pay that credit card off in full every month. You won't have to pay any interest or any fees. But if you can't, just pay more than the minimum to help avoid that interest charge. Some tools for rebuilding or building your credit could be secured credit cards, credit builder loans, or credit cards that have no annual fees or very low fees, such as $25 a year or less. So first, we're going to talk about the credit builder loan. What this is you build savings and credit simultaneously. So you establish a payment history to build your credit. You don't have to put any money up front, so that is one reason that I've always really liked this credit builder loan, and there's no credit qualification required. So whether you have no score or you're building credit for the first time, there's no credit qualification. You can ask for $500 or $1,000 loan amounts, and we have terms of 6 months, 12 months, or 24 months. I personally, as a financial coach, always recommend doing the 12-month or more option, and that's because, as we mentioned earlier, it takes about 6 months to help build up your credit score or start building a score. So that's why I recommend the 12-month or 24-month term. And the longer you build that positive credit history, the better. So this is just an example here. So first, a member would come in and apply for a loan with no credit pull. And let's say someone comes in for a $500 credit builder loan for 24 months. We would open a certificate of deposit for the member, and we would put that $500 in that certificate of deposit while the member's making those on-time payments for 24 months. The member would pay back the loan in those monthly installments. So for example here, $500 for 24 months would be about $22 or $23 a month payment. And then the total interest paid would be around $35 or $36. These rates can change based on how CD rates are and everything like that. But that's a pretty good rate to help build your credit and build savings at the same time. So the member would pay back this loan, this $22 or $23 a month for 2 years or 24 months. And at the end of the loan, the member would get the funds in the CD plus the interest earned. So this member would get the $500 back plus the interest it's earned in that CD. So they've built their credit and their savings at the same time. So some pros and cons of the credit builder loan is it will build your credit and savings at the same time. There is no credit pull or money up front required. So this can be a really great way to start building credit if you don't have a lot of money up front. And it's a lower interest rate than a credit card. There is 6% plus the CD rate interest on the credit builder loan, but it will be lower than most credit cards. And the only major con with the credit builder loan is you just have to reallocate your budget and make sure you have enough money in your budget to add this credit builder loan monthly payment, because it will add a new monthly payment to your budget for that 6, 12, or 24 months, whatever you decide. Next, we have our starter Visa card. And so this is for someone with no previous credit history. You've never been able to use credit before. This can be a good one for 18-year-olds or people just starting to build their credit. You must have no credit history and a verifiable income to qualify. So there must be some sort of verifiable income. Starter credit card limits are set by the financial institution. At Denver Community, our limit starts at $300, and after 6 months of using the card, we will revisit that limit to see if it should be increased, stay the same, and so on. There's no security deposit or money down because we set the limit. And we do offer financial education to answer any questions you may have about using a Visa card. Starting with the first time with credit, we want to make sure all the questions are answered and you have a good idea on how to use the card responsibly. So some pros and cons of the starter Visa. Well, for one pro, it builds your credit. It's great for first-time credit users because there's no money down or security deposit. A couple cons would be it is a lower limit credit card. So if you want to keep your utilization around 10%, you'd only want to put $30 or less on there. And you must have no credit history to qualify. So as I mentioned earlier, this can be great for first-time credit builders, but if you've already used credit before, this product will not be available for you. Our secured credit card. So this puts down a 1-to-1 ratio of funds frozen in a savings account to match the limit of the card, which builds a revolving line of credit. So basically you have to provide your own funds in a savings account to secure the card. The advantage of a credit card for credit building is that it doesn't have a term, so you can keep it open as long as you'd like to build your credit. Something that members have done before is you can use the funds saved through the credit builder loan to then use these funds to secure the credit card. So if you were to do a credit builder loan, you build up to that $500, you could take that $500 and put it as that security deposit for the secured credit card. The minimum balance will vary for these because you are putting your own funds up front, but we do have a limit of $250, and sometimes that can change. It can be different per institution, but you will want to keep the balances low, and that's why we do have a minimum, is because anything less than $250, you're really not going to be able to put much on that credit card to help build your credit, because you would want to keep it less than, $25 or $20 or so. Interest rates will vary for secured credit cards. So at Denver Community, we have the same rate of 12.99 for all of our credit cards, but they can vary per institution. So you'll just want to ask what their interest rate will be. Watch out for any fees. At Denver Community, we don't have any fees with this, but at some financial institutions, it can be expensive and they add a lot of extra fees for this card. I worked with someone who was paying $149 a year to build her credit with a secured credit card, which is crazy. $25 is what Denver Community charges for an annual fee in comparison, which is very, very low for the credit card market. So do look out for annual fees. Those can sneak up on you, and sometimes they're not always easy to find. I know I had a Capital One card and they were going to try and charge me over $100 a year just to use the card. And I was like, no way, I'm not going to waste my money on that. and no credit pull required at some financial institutions. So at Denver Community, we do not have a credit pull required for the secured credit card, but at some financial institutions, there will be. So secured credit card, it helps to build credit. It's great for first-time credit users or those rebuilding credit, since there's no credit requirement or credit qualifications. You do set your own limit for this card with your security deposit, and you can transition to an unsecured card later. So for example, if you open this card and you'd like to transition it to an unsecured card later, you can totally do that. Typically, I have members request to do that after a few years or a couple years of using the card, so the financial institution can see the on-time payments and the credit growth and then transition it to an unsecured card instead of closing it and then opening another, because that will ruin that credit history. Cons, you do have to have the money up front for that security deposit. It will have a higher interest rate than products like the credit builder loan. Even though at Denver Community, we do have a low rate of 12.99. And there can be a lot of fees associated with some credit cards, like annual fees or things like that. So it is important to read the fine print and look out for any fees that may be associated with a credit card. So strategies for great credit. 1, pull your credit report annually for free at annualcreditreport.com. Like I said earlier, right now, due to the pandemic, you can pull your report every week through April of 2021 for free. 2, pay your bills on time and pay off collection accounts. So on-time payments are the largest portion of your credit, of your FICO credit score. So it is important to pay bills on time, and then paying off collection accounts is a huge help to increase your score. 3, keep amounts owed low. So as I said earlier, that credit utilization, around 10% of your credit 10% or less of credit limit for the highest score possible, and then up to 30% of your credit limit to maintain good credit. So anywhere from 0 to 30%, I like to keep my utilization right around 10% or so to help grow my score as much as I can. Keep history as long as possible. So don't close your credit cards. You want to keep those open for as long as you can. You don't want to open a lot of new credit at one time. Keep inquiries to the necessary. So you don't want to open a lot of credit at once, close a lot of credit at once. It is important to space out your inquiries when you're going to be needing credit. Lastly, have a mix of credit. So this is what I'm talking about: installment loans and revolving loans. It's best to have a combination or a mix of both. But as I said, don't go into unnecessary debt just to build credit. What to do if you're in trouble? So if you're having struggles with credit and you're trying to figure out what to do, 1, decide to take control. Know that you have this situation going on and you need to get it fixed. 2, get a copy of your 3 credit reports. So go to annualcreditreport.com, pull all your credit reports and see what's on there. Call creditors at the first sign of trouble. So if you know you're not going to be able to make your rent payment or your electric payment this month, give that creditor or that agency a call to let them know what's going on. A lot of times they're a lot more willing to work with you if they have an idea of your circumstances and know what's going on than if they just don't receive a payment from you and you reach out later. Fix late payments or collections. So if you can, I always recommend members try and pay back that late payment when it's still with that original company. So for example, if I missed a couple months with DirecTV and it's not a collection account, I still owe them the money, it's better to try and pay that bill when it's still with DirecTV than to wait for it to go to a collection agency, because once it goes to a collection agency, it's a new negative account on your credit report. So fix those late payments if you can before they go to collections, or just fix those collections accounts, because either way, those are going to help to increase your credit score. 5, consider meeting with a reputable accredited financial counselor or credit counselor at a nonprofit to learn more about debt management plans. So we currently work with Green Path. They are a great partner of ours, and they do debt management plans. They work with members who are struggling with their credits and things like that. And we'd be happy to refer them to you if you're interested in working with them. Lastly, I have some resources here. Additional resources will be shared with Tessie. Schedule a free one-on-one financial coaching session. So I am one of our financial coaches at Denver Community. You can schedule an appointment at denvercommunity.coop/coaching. This is a free service. You do not have to be a member of the credit union to schedule an appointment. We can go over any personal finance topic, from building your credit to making a budget to creating financial goals, you name it. Right now, we're doing these online by phone or by Zoom, so I'd be happy to meet with anybody. Next, we have our free e-learning courses in both English and Spanish, and these cover a variety of different personal finance topics, including credit scores, building savings, protecting your identity, home buying, family conversations about money. It goes on. You can access these at denvercommunity.coop/learning, and these are free. There's no download or email sign up required, and they're about 5 to 10 minute modules. They're really great and easy to understand. They can be great for kids too.